So even though the whole economy is slowing, that shift from good to services is actually good for the Caribbean. It's good for tourism-dependent economies because Americans are traveling more, they're investing more in leisure activities and so forth. And so that's proven, I think we've seen across the region, the Caribbean, that's proven quite a big boost to the economies. We don't see a recession, so we feel that potential flow of tourism is going to be maintained. But I think it would be prudent for the countries in the region to think about what would they do if it were to slow, if the US were to slow down, if interest rates in the US had to go higher in order to bring down inflation, not as a baseline scenario, but more as contingency planning in case the US were to slow down. And the same is true for Europe as well. This slowdown is not surprising, given that the region's main trading partners are also slowing. The favorable terms of trade that we saw in the aftermath of COVID have lessened somewhat, and global financial conditions are less friendly than they were a year ago. The bad news, though, is that inflation remains high across the region. We know this high inflation disproportionately hurts lower-income households, particularly as it has been concentrated in large increases in food prices and because wages have been unable to keep up with these higher prices. After peaking at around 10% in mid-2022 for the average of the region, headline inflation in the largest Latin American economies has now decelerated to around 7% in March. However, progress in bringing down core inflation appears to have stalled.